We've got Adrian Mowat of JP Morgan Chase joining us on the phone line. Adrian, the ratings outlook in India has been changed to negative from stable. What would you make of it?
I think this is unsurprising. And if you think about what you've been talking with regards to GAR, the focus of markets, the questions you'll be asking people who come onto your show about politics, policy framework, you know, I think what S&P are saying is really along the themes of what's already been driving the market and the rupee. It's clearly unhelpful in that India is a capital importer with a current account deficit. A group of Indian corporates do have relatively large standing external commercial borrowing. Some of that is maturing this year. And so the risk of a rating downgrade will make the refinancing of that debt harder to achieve. So, generally this is not what India needs at this point in time, but the rationale that is being given by the S&P from what I've seen from the headlines seems to be consistent with what investors were already concerned about.
Sure, but Adrian, assuming that this triple B negative outlook remains for a while, and at the same time we have the government, being a little more clear in terms of regulations, especially on the GAR front, do you believe FIIs might then just ignore the sovereign rating and still continue to have faith in the Indian economy?
Well, I think there's been this issue with GAR, the taxation of foreign investors, some concern about retrospective legislation. There's then been very strong feedback to the government about people's concern with regard to that policy. I would have thought that what the S&P has done now would add to the pressure on the government to perhaps reconsider the policy, and if it pushes us in the direction of a more rapid clarification, then it may prove to have been a good thing in terms of investors' perception of risk.
Sure, but Adrian, wanted to also get in your view as to what you believe the major challenge is likely to be for India's economic outlook, because, it's a combination, as we've been talking about, of lack of policy initiatives from the government. There's also been, poor economic management. There's been the rupee, crude oil. What do you think is the biggest headwind?
The biggest headwind, I would argue, is the policy framework, the speed at which decisions are made, people's confidence to make long-term investment decisions. India remains a very good long-term growth story. It's a place where you do have profitable businesses. There is capital that is willing to invest in that story, and really what they're asking for is consistency in policy and efficiency in implementation. And if those two things can be achieved, and there's no structural reasons why India can't achieve that, then I think the whole investment case for India will turn around. So that's what we would like to see from policymakers. That may be difficult to achieve in the current political environment, where the coalition is weak, and making the decisions which are more medium to long term is just harder in this environment when the coalition is fighting for its survival.
Adrian wanted to react to Shankar's statements. I mean, he said there was no case for S&P to have lowered this outlook. We should not pay heed to it, given that the macro fundamentals of our economy are fairly robust. And to quote him, we should just nod and move on. How would you react?
Well, I think Shankar highlighted that often the S&P downgrades occur after the capital markets have moved. So I have some sympathy with that view. But I would say that the rationale they're giving is reasonable. People are looking at India and saying, look, my investment risk has risen because of proposed retrospective legislation. The return that I require from investing in India has risen if India is going to charge me a capital gains tax that I do not pay in any other country as an institutional foreign investor. So there are negatives there. I agree with the point that there's a big dispersion in returns, and there's been a lot of money to be made in India if you've been in the right sectors and countries. But I can make exactly the same observation of all the BRICS as well. Some of the biggest, internet stocks in China are up more than 40% in the last 2 months. Some of the Brazilian retailers have also done very well. So, I think India puts itself at a competitive disadvantage with its tax structure. I don't believe the Indian exchequer will make more money out of doing that, and it will push up the cost of capital, which is broadly negative for a country that is a major capital importer.
Adrian, one word on the currencies as well. We have seen most emerging market currencies really decline, and this coming in after Indian rupee has continued to decline. We've seen it come down from 48.60 to around 52.86 during the day today. Where do you think the currencies are moving in that sense?
Well, we're not seeing a broad trend in emerging market currencies, to be honest. There's a bit more of a random move. The rupee appears to have moved into a more volatile trading range than we've been used to in the past. And it does run the risk of going back up to the sort of 55 level. It's extremely dependent on capital flows, including FII flows. And so we're sitting here with quite major policy risk with regards to the taxation of FIIs. It's possible on the 7th of May we get clarification that's encouraging, and you start to see some of the money that might be sitting on the sidelines coming in, and that would help the currency. It could go in the other direction, and the currency could sell off. So at this point in time, I don't have a lot of confidence in trying to predict where the rupee is going to go over the next couple of weeks, let alone the year.
One of the key concerns that S&P has spoken of is India's external position likely weakening from here on and the current account deficit widening. They've also, in the same breath, spoken about the GDP growth in the current financial year possibly coming in only at 5.3%. Would you say that that's a little too pessimistic?
I suspect that the economy is probably weaker than the data suggests in terms of GDP, just as it is in places like China. But what we would expect to happen is with the easing in policy, with inflation coming off, then growth will be accelerating into the second half. And it's a bit late now worrying about the growth numbers. In terms of the outlook for import costs into India, I agree with Shankar that these things are going lower, and that the China situation is China's going to go from having a hugely disproportionate share of global commodity imports to a more normal level as its economy does a necessary rebalancing. And the India and the Turkeys and the other current account deficit countries should be beneficiaries of this as their current account shrinks. So if we're right about this outlook on commodities, then the subsidy bill goes down, the current account bill goes down, and some of the risks that S&P are highlighting may actually diminish. If we don't get that call correct, and you will have certain parts of Indian industry that's needing to refinance debt, and this will make it harder for them to do that. And I think it all comes back to a story that, again, being highlighted, is that this is about stock selection. There's an awful lot of money to be made out there in the emerging markets, even though the broader indices aren't doing so well. There's a big dispersion in returns, and part of that dispersion in returns is a reflection of relative strength of balance sheets. So if you're in the right sectors with good balance sheets, then you're generally making good money. If you're in the wrong sectors with bad balance sheets, there's probably a lot more downside.